Have you ever wondered what would happen if you woke up tomorrow and your investing app went bust? What if Vanguard went bankrupt and you couldn't access your money? This is something I get asked almost every day, and it's what most people are getting wrong, and they don't realise their money is at risk. Even putting your money in places that give you a lower fixed return or super safe index funds doesn't always mean that you're protected. I'm getting this question even more now, as I've got multiple accounts over the £85,000 threshold that's supposed to protect your money, and people think I'm crazy for taking the risk. So, are my investments protected? Let's break down whether I'm doing the right thing and if you should have all of your investments on one platform or split them across different accounts to spread your risk. I'll tell you about a secret rule not many people know about and explain which investments are safe and which ones aren't, which may surprise you. As of today, there's nearly 750 billion in ISAs held by UK adults. Out of that, there's 285 billion in cash ISAs and around 456 billion in the stocks and shares ISAs. Over half of over 65s have an ISA, and the total across all age groups is 22 million people. But out of all of the adults in the UK, only 8% are taking financial advice. I suspect this number is now dwindling as more and more people are realising they can invest for themselves and don't need to pay for financial advice. Over 50% said that they had no need for an advisor, and 28% believe decisions could be made on their own. Although we need to recognise there is a place for financial advisors in some specific situations, such as retirement planning and more complex financial scenarios. But with so little people taking advice, it's never been so important for protection to exist for customers. Investment platforms would like to do more, but they have to be careful as they can't be seen to be giving advice and they need to remain independent. So when it comes to keeping our money safe, there's two main things you need to be aware of. There's the FCA, which is the Financial Conduct Authority, and there's the FSCS, the Financial Services Compensation Scheme. The FCA regulates the conduct of nearly 45,000 businesses in the UK to ensure the financial markets work well. They want to make sure the financial markets are honest and competitive, so we as consumers get a fair deal. The FCA is a public body under the purview of the UK's Treasury and Parliament, and it helps fund itself by charging fees to the firms that it regulates. Every business that conducts financial activity in the UK has to be regulated by the Financial Conduct Authority, so that's the first thing to watch out for. A major red flag is if a company isn't registered with the FCA. A firm should prominently be displaying this on their website, most likely towards the bottom. But you should always double check with the FCA register to make sure they're on it and look at what activities the platform is regulated to do. This is under the activities and service section on each regulated firm's page. I personally try to make sure I'm only recommending platforms which are FCA regulated or clearly state that they are regulated by a different body, which I try to avoid. This may differ depending on where they are located, but the majority will all need to be regulated if they are conducting, trading and doing promotional activities here in the UK. All major platforms in the UK will be regulated by this. It's likely if you find a smaller name or a less heard of brand, you'll want to be extra careful. What they do is essentially put guidelines and rules in place that businesses have to follow, and this now extends quite heavily into promotional activities, like promotion on social media. Recently, a bunch of influencers got into big trouble by promoting a Forex scheme which was unregulated, and they're facing legal charges, so the FCA is pretty serious about this. Crypto has also been hammered. If I include a sponsor now, even if they're FCA regulated, I have to state that you may lose all of your money. Even in a short period of time, the changes I've seen of what you can and can't say have gotten severely stricter. Now, pretty much all of my content has to go through rounds of revisions through compliance before I can publish it. It's a complete hassle for me, but it's good for consumers as they can be protected. Hopefully, if more people continue in this way, it will extend the longevity of YouTube investment content, as if affiliates and sponsors weren't able to use YouTube, I suspect we would see quite a decline of the people making content, just because it wouldn't be sustainable to do so. The FCA has made it pretty clear that they're ready to punish those who don't comply, even if by no fault of their own. A prime example was in 2022 when free trade were banned from advertising with influencers after a second supervisory notice was presented to them. After an influencer with over 64,000 followers explained how she cleared £38,000 of debt, which gained widespread media attention mention. And of course, she was referring people to free trade, which may lead viewers who are in a similar situation to believe if they invest, they can do the same thing. The level of regulation in the UK compared to other countries is on the higher end, which for the consumer is good, and we should think of it as a positive. The FCA also has something called the CASS, which is a Client Asset Sourcebook, which makes platforms have daily and monthly asset reconciliations, and it requires them to be very robust. They also have financial solvency rules, which means the FCA has adequacy rules in place, which means that businesses have to have a certain amount of capital set aside to be allowed to trade, and they have to be happy with their financial plans. I imagine for firms that can be frustrating at times. Having worked with them, it's a big part of the reason features can be so slow to be added to investing apps. I know the biggest bugbearer for a lot of people is when I show an app and people are like, when is their ISA coming? And a lot of the time it's a slow, drawn out process, which a lot of the time isn't anything to do with the platform specifically. Most of them are dying to open an ISA, as it's the key account that any platform needs to open to be successful here in the UK. So the key takeaway here is make sure the firm is regulated by the FCA. Simple. Now, let's move on to the not so simple, and this is what the majority of people are getting wrong: the Financial Services Compensation Scheme. Once you've checked the platform you're using is on the FCA register, the next step is to check if they are carrying out a regulated activity covered by the FSCS. There's some different rules around this, and they have changed over the years. This used to be £30,000 plus 90% of any extra up to 48k before Jan 2010. Then until March 2019 it was £50,000. But now for any firm after 2019 that failed, it's up to £85,000 per person, and more importantly, per firm. So this means that if you have investments on different platforms, you could claim multiple 85,000s and have more protection. Of course, this does hedge your bets. If one goes down, then you're okay elsewhere. But there is a catch. If you're looking to do this, you need to check that the firm isn't using the same FRN number or authorization number as another firm. Some will operate multiple brands under one number, in which case only one compensation would apply. But if that's the case, it doesn't seem great, because most people will build up over £85,000 in their investments in their lifetime. And this is where people get confused. First, we need to think about what the £85,000 actually covers. It covers the cash balance on your account and specific investments. But there's something most people aren't aware of here, and it's that the FSCS is like a second failsafe. By that I mean there's a separate ruling by the FCA which states that regulated platforms must hold clients' funds separately to their own accounts secured by a third party. So it's likely you would never need to use the £85,000 when it comes to your cash. And this makes sense. I mean, think about it. The compensation scheme doesn't want to be paying out tens or hundreds of millions of pounds. It would make far more sense for them to make sure the funds are protected in the first place. So anything under £85,000 in cash in your account is protected. Above that is by segregation, but not covered by the FSCS. If you plan to have more than this in cash ISAs, it would make sense to split your money just to be extra safe. But most of us are investors and we invest our money. So how is that protected? Now this is a part that may shock you. The FSCS protection only applies to UK domiciled OEICS and unit trusts. If you're wondering what in the world is an OEIC, it's an open-ended investment company. It's created in the UK and it's structured as a company in its own right to invest in stocks and securities. It also doesn't apply to funds that are domiciled overseas, such as Ireland, or things like shares, bonds, and cryptocurrencies. And perhaps most shocking of all, it doesn't cover exchange-traded funds. So what can we actually do about that? Well, I've got over £200,000 in ETFs as of today, so am I making the wrong decision? One alternative would be to go for an OEIC, such as a HSBC FTSE All World Index. In fact, this fund is the best performing fund I bought in my lifetime ISA. It's up 23% since I bought it, and it's very good indeed, and it has performed well. The issue is, however, it's a fund and not an exchange-traded fund, so I'm applicable to uncapped management fees. This has been lowered to 0.25% on Hargreaves Lansdown, but it's still scales. So the fee is £25 per 10,000 that I have invested in the fund per year, which would scale up to £250 per 100,000. It's not horrendous in a lifetime ISA because I'm not going to have that much in there and there's a lowered charge, but it could almost double as it's 0.45% charge on an ISA, and you would have to use HL or similar to do so because some of the other low-cost providers don't have these types of funds. If you are willing to pay the increased charges, then that's an option. For me, it would be roughly £1,000 £1,000 per year, which I'm not really wanting or willing to pay. Now, luckily for us, there is an exception to this rule, and it's where the big majority of confusion comes from, and it's not explained particularly well on the videos you'll find online and on the FSCS website, so let's make this as clear as possible. We've got the protection of £85,000. Then you've got an investment platform and an ETF provider. These are the keywords here that we need to make sure we get right. If you had up to £85,000 in an ETF on a platform, and in scenario 1 the platform went bust, there's two things that could happen. First is that as long as your money still sits within an ETF and it's segregated as required by the FCA, it would be transferred to another platform of your choosing. In this situation, you could also have up to £85,000 of protection on your ETF. Most people think this just applies to your cash balance, but it also applies to your ETF. This is because you're covered by being an activity being provided by the platform. But the reality is, as long as a platform is segregating the cash and funds properly, as regulated by the FCA, the £85,000 protection is essentially a second level of protection or a shield that's hopefully never needed. Now, this is where the risk comes in. If the ETF provider went bust, you aren't covered by the FSCS protection. We need to acknowledge that with investing does come risk, and an ETF is essentially a collection of stocks. If your stocks went bust, you would lose your money, but we're spreading that risk by buying low-cost index trackers, which is broadening our exposure. And by that measure, the more companies we go for, we essentially spread our risk more and more, because the chances of thousands of the biggest companies in the world going bust in one hit is pretty slim. Sometimes ETFs can become delisted, which is very rare. It happened to me only once buying a Russian ETF through HSBC, which was very unlucky. In that case, my money is almost gone, and hopefully I'll get it back one day in the distant future. We're yet to see. It's essentially just frozen in time. While it seems all good and well looking at these new ETFs, which are up and coming, which sound so interesting, being too ETF focused can be a bad thing. I always say to stick within the top 10 or preferably within the top 5 of ETF providers by size. These are BlackRock, more commonly known as iShares, there's Vanguard, there's State Street, Invesco, and Charles Webb. And within the top 10, there's still a few more you'll likely recognise, like JP Morgan, there's Wisdom Tree, and there's a few more good ones. But sticking within the well-known brands that have billions under their management is a good move, avoiding smaller up-and-coming investment providers. That way you know you're with a well-established provider with a history of reliability and performance. This will reduce the chances of anything bad happening. The next thing to realise is that investments are also required by regulators to be segregated too. This means that something was to go wrong with the platform you use, and let's say you had £500,000 in the Vanguard S&P 500 ETF and the platform went bust. You would still have your $500k in the fund, it would simply just be transferred to another platform of your choosing. It's set up in this way so that client investments and cash cannot be claimed against if something were to happen to the company. So the company's finances and your finances are completely separate. So in that way you're protected. The only failing of this would be if the company wasn't following FCA regulation, which the FCA are like bloodhounds and would find and punish before anything was even going to happen with their scrutinous audits. You may have a bit of hassle if something were to happen to the platform, but your investments would be fine. In theory, the ETF provider should be segregating their assets too. So if they went bust, the fund would still have value. However, the value of the fund would probably crash due to a rush of people trying to sell out, so it's likely to be worth less. This is why it's so important to use both a fund provider and a platform that takes it very seriously. I often recommend InvestEngine, and it's the main platform I use, so let's talk about what they specifically do to safeguard your investments. InvestEngine hold all client cash in a pooled client account at NatWest Bank, and their investments are pooled in a client account at Crest, who are operated by Euroclear UK and Ireland. These are segregated from the firm's money and investments. InvestEngine and its third-party partners have no legal right to your money and investments, and they cannot use them to cover any of InvestEngine's obligations. They are also subject to CASS regulations and regular audits, which includes their future investment plans. All content I produce for or with InvestEngine has to go through compliance to ensure it's as accurate as possible. I feel completely comfortable having my money with InvestEngine as I save on fees while building my investments and then being responsible with it, following all the right procedures, and I'll continue to recommend and use them personally for the foreseeable future. I hope this video has gone a long way to answering your questions, as I do get this question so often, and hopefully now you know what is safe and what isn't. If you'd like to take a look at some of the best, safest funds to invest in, this video might be super helpful. Thanks for watching, and I'll catch you over there.